Alex, thanks for joining me today. It's great to have you.
It's great to be here, Brandon.
This is a special episode for me. It's not every day that you get to interview your boss and the person that you've worked alongside for many years. So thanks for indulging me. The bar is getting higher. So excited to dive into our conversation today. Can you start by sharing with our audience a little bit about, your background and your journey leading you up to the formation of Juniper Square?
Sure. Yeah. No, I'm really excited to be here. I've been enjoying the podcast and enjoying seeing you with this new dimension of amazing podcast hosts. In addition to the OG salesperson at Juniper Square, really built the company alongside me and the co-founder. So it's pretty special to be here with you and to see your latest chapter here with the podcast. So thanks for having me. So Juniper Square is actually my third startup. It takes me a few times to kind of get things right usually. And the first two were, all three startups have had a similar focus. I've always been very interested in the role that technology can play in making financial markets more efficient. And that was true for my first two startups. That's true for our mission here at Juniper Square, focused on private equity. The first two were not as successful as we've been so far. One was a total wipeout. One, we did okay. And the second one was great because it put me in the position for the first time of being an LP, writing checks to private equity funds, investing in real estate deals. And that was ultimately the genesis of Juniper Square, which we can talk more about. And prior to doing startups, I started my career at Microsoft. I was a product manager at Microsoft in a few other roles for 5 or 6 years. And then I came down to the Bay Area where I live to go to graduate school for getting my MBA kind of in the mid-aughts time period.
And what was it, so here you are, you had started two other companies. I mean, get us into the mindset of an entrepreneur. Clearly, company building is in your DNA. Once you left Microsoft, this is the journey that you went on. How did you conceive of the idea for Juniper Square? And what was the problem that you saw that needed to be solved?
Yeah. So this is back in 2013. So it's actually about almost 10 years ago to the day. I remember putting together kind of like my first sketch and notes for Juniper Square in the June timeframe of 2013. So it's crazy. It's literally a decade, almost on the dot. And the genesis for the company was really for me as the first time stepping into the shoes of being an LP investing in private equity. I didn't do that growing up. I didn't come from a family that was, allocating to private equity. And so it's sort of a world that I knew a little bit about because I had classmates from business school who worked at private equity firms or worked at real estate investment firms. But I'd never been an investor. And in that experience in 2013, where we'd sold my second company and all of a sudden I had some liquidity to be a private markets participant, I was really shocked that for these huge asset classes in private equity, I mean, there's tens of trillions of dollars globally in private equity, that subscription packets were coming to my house via FedEx trucks for me to fill out by hand and take down to a local notary to get notarized, and then sending them back to the GP or the GP's lawyer's office on a FedEx truck. And I was just shocked that in the public equities markets, buying a stock on the New York Stock Exchange or the NASDAQ, I could go online. There were tools like Charles Schwab, Fidelity, name your low-cost brokerage. And the entire experience was digital. I'd create an account, I'd link up my bank accounts, I'd go shopping for security, I buy that security, share a Microsoft or whatever. And in the world of private equity, it was completely not digital. It was as though the 30-year transformation of the public equities markets from 1980 to 2010, where they really went from like Gordon Gekko style phone calls to your stockbroker who's going to charge you 10% for a trade to clicking buttons on a computer. That entire transformation in the market had not touched private equity, and I, as an entrepreneur, I just couldn't believe that was true. I was like, surely it just must be I'm not looking in the right place, and that these GPs that I'm working with, just aren't choosing the tool set that's available. And, you kind of start tugging on those threads, get interested in a problem and realize, no, like there's, probably 10,000, maybe 20,000 really high quality GPs in the world across, real estate, venture capital, private equity, trillions of dollars of capital. And it's just moving around via spreadsheets and emails and PDFs. And we saw a vision, my two co-founders and I, from the early days, that really these really huge and important financial markets should be mediated by technology. That we should be doing the pre-trade and the trade and the post-trade in open, stable software systems, not by FedEx truck. And that was really the genesis for the company. And we thought that somebody had to come along and kind of digitize all these private equity partnerships and do it at real scale. And if you did that with an ultimate eye toward enabling a market, connecting GPs and LPs around a digital record of private equity ownership and making a market, that you could really have a transformative impact. And the world of private equity could become digital. It could become accessible in the way that public equities have. Everyday investors can participate. That's a big part of what motivates us at Juniper Square. And now, we're I would say, reaching some degree of adolescence. We're very early in that journey still, but we have 2,000 GPs that we serve as customers. They're managing more than 1 million private equity positions across tens of thousands of funds, trillions of dollars of capital. And we're probably at about 10% share of the overall private equity universe that we're aiming to digitize. So it's still early innings. We're kind of well on our way towards that mission.
So if you're interacting with Juniper Square today, you may, take it for granted that this was always going to be the company that it is. But, having kind of built the business from nothing, as you reflect back, are there any kind of like milestones or pivotal moments that, you kind of look back to be like, aha, like when we were doing that, I wasn't sure if we should go right or left, but we went right. And as a result, we're on the right track? Or has it been, fairly continuous building towards this vision that you set forth on day one?
It's really, it has been quite continuous. I'm honestly really, I'm quite surprised at how continuous it's been. I mean, and at some point, maybe we should publish these things publicly, but if you go back and look at like our seed fundraising deck, from the first, capital we raised at Juniper Square from outside investors, it's sort of the same mission. It's the same set of activities. It's the same strategy written in, 2015, I guess it would have been, that we're pursuing today. So at some level, perhaps what's surprising about it is that this path that we put ourselves on, we still think is the right path to ultimately achieve our mission. And I can tell you that, when we looked at the market, what we saw is that you have this dynamic, you have this adverse selection problem where the really great managers in real estate, in venture capital, in private equity, they have a line of investors out the door that want to work with them, right? And then conversely, the really great investors that every manager wants to work with because they're kind of they're like a bell cow for the rest of the industry. Some of the more famous endowments, let's say, that other people tend to follow. Those investors have access to all the managers that they could want. And so because you have this adverse selection problem, it really prevents you from going directly to building a marketplace. And around the time that we started Juniper Square, the Jobs Act was passed. There must have been 100 companies that started in varying crowdfunding approaches. But this idea of going direct to building a marketplace, we'll have all these managers post their funds and their deals online, and then we'll connect the buyers and the sellers, and we'll just scale to infinity. And what you saw with most of those businesses was this adverse selection problem on display, which is the really great managers, the ones that you would want to invest with if you got the opportunity to do so. They're not interested. They're not interested in posting their investment opportunities on a public website. And so we saw that problem and we said, well, somehow you have to kind of go partnership by partnership in a little bit the same way that TurboTax went state by state and county by county and municipality by municipality in digitizing the tax code. It's sort of big project. You got to patiently work through it. But the fact that TurboTax has a digital representation of every state and kind of local tax code gives the user this very disruptive experience of being able to go through a really seamless, elegant process of filing a tax return. And we sort of took inspiration from that and really from OpenTable and their approach in the restaurant reservation space of being like sort of the ERP for table management, and said, okay, well, we aim to kind of become the record of all these private equity partnerships. In the process of doing that, we're going to connect the GPs that manage those partnerships, the LPs that provide the capital to them around the same record of ownership. And we're going to do that with an eye toward building a consistent data model for the entire private equity industry. So every one of the many tens of thousands of funds on Juniper Square all tie back to a consistent structure, a consistent way of understanding, what is a private equity fund, what's a position in a private equity fund. And so we started with that end goal in mind. And let me tell you, like back in 2014, 2015, I would go around and be like, hey, we are building investor relations software for, we started in real estate as our initial asset class. We're building investor relations software for real estate investment firms. I think we got like 0 out of 100 investors in my first target cohort list were interested in that idea because it seems so stupid and it seems so small. But to us, we were like, no, this is the path for, really digitizing this very opaque, very structured market. And it ended up, it has provided us a platform to now build a pretty reasonably sized fund administration business on top of our platform, where I think we're the fastest growing fund administrator of all time. We'll soon be launching a capital markets business on top of that same platform. So it's sort of one of these, you got to go slow for a while and be willing to be misunderstood for a long while. And then ultimately, you've got something, what I hope will become to be seen quite disruptive.
The idea that you need to digitize the relationship between the GP and the LP, that is not something that, the way that you framed it, where you took inspiration from OpenTable and, TurboTax. I mean, why is it that what was happening before Juniper Square came along and this digitization took place? Because to me, or to somebody on the outside, it may seem obvious. Of course, you need to, digitize the relationship and have an actual system of record. But what did the world look like kind of before solutions like Juniper Square existed?
Yeah, I mean, it was every GP did things their own way. They and the record keeping system often was Excel. The communication system was email or phone call. I mean, literally emails like, please wire $30 million to this bank account, and that's how it worked. And, we spent a lot of time in the early days trying to think about and understand, why was it the case that the public markets became digital and the private markets did not? Like, why? Because understanding the answer to that question really informs the strategy. And what we ultimately came to was, in the public markets, the role of the regulator, here in the US, the SEC, is supremely important because they have an ability to enforce standards, right? So they can say to every Microsoft or Google or Coca-Cola or anyone who wants to list on an exchange, this is what it takes to list on this exchange. This is the way you have to do your financials. This is when you have to, have them submitted. And they can enforce changes to those standards. So they can say, instead of, mailing us paper forms of these records, we're now going to require you to submit them digitally, right? And then boom, they've got the power to sort of shift the market to digital. So there's an element of standards and standards enforcement that the regulator plays. And then the other really important role that the regulator plays is a point of data aggregation, right? Where all the, issuers in a marketplace kind of have to funnel through. And the world of private equity, conversely, is just thousands of GPs and hundreds of thousands of LPs all connecting. The whole idea of private equity is that these are unregistered securities. You're not going through the headache and cost of a public listing by relying on, certain exemptions, like not allowing, limiting the number of investors and only targeting wealthy people and so forth. And so by definition, you're avoiding the regulator. And so the dynamic is just one where kind of GPs and LPs make it up. How there's some degree of standards, there's some degree of convention. There are some industry bodies that have pushed for a long time to try to get everybody to agree on common definitions for concepts of private equity reporting and ownership. But the reality is, GPs kind of do it how they want to do it. Powerful LPs enforce and require, their standards on GPs. And so that fact means that some company has to come along and be willing to embrace that heterogeneity. You have to be willing to say, I'm going to take it as a given that GP A is going to do things differently than GP B. and I'm not going to try to get them to agree on a standard any more than TurboTax is like, geez, I'm trying to get California and Washington State to agree on the same tax code so that I don't have to like digitize two different tax codes. That would be absurd. That's sort of the same approach that we've taken, which is, okay, well, there's a real like configuration problem here where you have to support a vast array of different ways of doing things that all tie back to core concepts, right? Like there's core concepts in private equity, like how much cash did the investor give to the fund? How much cash did the investor get back from the fund? When, et cetera. And that's the approach that we took, and it's proven to have been beneficial so far.
So, last question on the Juniper Square story before we kind of move on to the next chapter. Juniper Square today is a company that serves the entirety of the alt space: private equity, venture capital, commercial real estate, private credit. But the business started in real estate. Why did you choose real estate as the origin or the asset class of origin to build the business?
Yeah, I mean, it's hard to build a business, and having this being my third time, and my co-founders had started other businesses before as well, so we'd sort of learn lessons the hard way many times. But if you're just three people getting started around a kitchen table, it's great to have like grand ambitions of what you'd like to do one day. But the reality is you're limited by what three people could do in a day. And so therefore you want to try to reduce the scope of the problem that you're solving as much as possible, to get to like the narrowest set of customers, the narrowest set of problems that they have, so you can make meaningful progress against that narrow set. And so for us, we knew that meant that even though we saw this as a pan private equity problem, like there's, anybody who has a fund has the type of problems that we work on, whether that fund invests in companies like Juniper Square, in aircraft leases, in buildings, in timber, whatever. A fund is a fund is a fund. And we knew that to be the case, but we also knew that we really needed to specialize and pick a narrow customer set early on to be able to meaningfully make progress for that customer and kind of get something off the ground. And for us, why real estate versus, say, focusing on venture or private equity, some of that is just a function of where I had a network, like where did I have personal relationships with GPs? Like that really matters, right? Because it's pretty hard to get a company to, trust a startup with financial reporting and, things like payments and other stuff that we do. The second was that real estate is, of the private equity asset classes, is probably arguably the most information intensive, which is to say LPs tend to want to know more about the portfolio details of their real estate investments than they do the portfolio details of their venture investments, let's say. So the load on kind of like information exchange between GPs and LPs is higher in real estate than it is in venture or private equity. And then the third reason is real estate, for reasons that you're exploring with a lot of the guests on the Distribution podcast here, has traditionally been a laggard or really a slow adopter of new technology. Whereas, say, like hedge funds, another asset class that are broadly considered to be part of alternatives, were very rapid early adopters of technology. And so the fact that so many of these real estate investment funds had been slow to adopt technology meant that we could come in and sort of leapfrog and have a comparatively much better solution for them than the status quo, than some other firm that had invested a ton in, let's say, building a custom solution to automate their investment operations or something like that. And so for those three reasons, we focused on real estate in the early days.
And just to clarify for our listeners, when you're talking about fund, that can be a traditional fund, a closed-end fund, an open-end fund. It can also be any sort of a structure. It can be a deal that, in the real estate context, it might be, an investment that's capitalized at the, asset level that's not necessarily living in a fund structure. Is that correct?
Yeah, I use the word fund loosely. I mean, I could use the word investment entity, to be more precise. It's kind of a mouthful, but we support everything from, like, in real estate, it's very common to do joint ventures. It's very common to raise money in SPVs that are formed to, let's say, go buy an apartment building from individual investors. It's very common to have closed-end funds. It's very common to have open-end funds. In fact, much more common in real estate to have open-end funds than it is. You see it quite rarely in venture. In fact, I can only think of really an N of one now with Sequoia's fund in venture that are truly open. Very common in real estate. We support all of it from open to closed to, Cayman-based to US-based to individual SPVs to JVs and kind of everything in between.
Yeah, absolutely. Well, that's helpful context. So, as part of the journey, the company started as a SaaS platform, kind of running, what would be a kind of traditional SaaS, which is software as a service, playbook and pricing. And a few years ago, the business moved into launching a fund administration business. How did fund administration, first of all, why did you choose to enter the fund administration space, and how does that fit into, the overall, business, long-term business plans or business goals?
Yeah. So, I view our job as to take care of, and Jeff Bezos is popularized and is credited with this term, certainly not mine, but to take care and do all of the undifferentiated heavy lifting for GPs around their investment partnerships that are common to all GPs, that no GP wants to do, that are, not going to differentiate them from their peers, so that they can be focused on investing and creating value through their investment strategies. And so that means that things like securing capital call workflows or treasury operations or moving money securely or reporting on their investments or, doing the accounting on their investments. Like, these are things that really no one GP can really specialize in. They're not going to raise more money than somebody else if they got a really great accounting operation. And so our strategy as a business is to say, look, the private equity partnership is sort of the core focus for us. And we look at that partnership and we say, what are all the things that the partnership needs that are undifferentiated across all of these different managers and that lend themselves to a scaled provider, providing a solution for many GPs. So we can now work on a problem area and apply that solution to 2,000 GPs, tens of thousands, hundreds of thousands of partnerships, and no one GP, not even, the biggest like Brookfield or Blackstone, have that same level of scale. And we've always been very clear that, that our strategy is to support the GP, right up into the boundary of their investing activity. So we're never going to get in the business of competing with our GPs. Never going to go raise funds that compete with them in the market. But all the sort of middle office stuff, even front office stuff that they really shouldn't be doing, we want to build solutions for them and bring it onto the platform. And so fund administration for us is really the first of many of those types of businesses that will build around the private equity partnership. It's a really huge market. It's a huge TAM. And it was a big unsolved need for our customers, even though we serve 2,000 GPs today, but it's still the case that a majority of them are in real assets. So many of our real assets managers were either deeply dissatisfied with their current fund administrators or were still managing fund administration in-house. So it was an area that our customers were pushing us towards, saying, hey, we're really dissatisfied with the status quo here. And it's an area where it's still largely been untouched by technology. And the sort of fund administration business is one where there have been innovations in it. Like it kind of started as the back office really of some really big banks. And, a lot of those back offices were spun out in the 90s. And then there was a wave of kind of industry consolidation. And that was like the first wave in fund administration of sort of value creation. And there was a lot of private equity backers that were playing in that, buying subscale fund admins, combining them together, selling them off as a bigger, more profitable entity. And that was sort of wave one. And then wave two was like largely taking advantage of human capital arbitrage. So, if you can do something more cheaply in a low cost labor market than you can do, say, in New York, well, have a fund accountant be based in that low-cost labor market instead of in New York, and you can drive, improvement in margin that way. And then we believe very deeply that there's a big third wave coming to these types of accounting-oriented businesses, which is so much of the work that it is to be a fund administrator, that it is to do the fund accounting, can and should be automated by software and will be automated by the software. And that was really what made this very compelling for us. Is huge market. Our customers are asking us for solutions, are very dissatisfied with the status quo. And we believe it's an opportunity that lends itself to real differentiation through technology, which is what we look for, and also is strategic to ultimate capital markets scenarios that we want to enable for our customers. So if we're administering the fund and we hold the complete book of record for the fund or the investment entity in Juniper Square, it's a lot easier for us to enable a secondary trade, for example, around that fund if we are the administrator of record, than if we just have a thinner representation of that same fund in investor relations software.
And we've coined this term modern administration. And so it sounds like, from your perspective, modern administration is really about kind of the combination of the traditional service model, but the overlay of technology to drive efficiency. Is there something more to it than that as you look at the kind of macro environment or the landscape across the different providers that exist today, where you think there's additional opportunity for disruption or change?
Well, yeah, I think we have a very healthy respect for the fact that, if you are a CFO of a private equity fund or series of private equity funds, you are probably going to want a relationship with the human, not just with software. Like, even if software can theoretically automate the entirety of what it is to be a fund administrator, you are going to want, this is a consultative relationship, right? You want to pick up the phone and call someone and be like, hey, we're thinking of starting a credit fund. Like, what have you seen? Or, hey, we're thinking about moving the fund to Cayman. What have you, there's a lot of interaction that can and should happen between the private equity firm and the fund administrator. And it should be a consultative relationship. And so our view is that human to human connection is not going away at all. And in fact, will become a point of differentiation, an increasing point of differentiation over time. It's like, can you actually call someone up and can they have an intelligent conversation with you and give you advice? And so that is always going to exist. But so much of the work that happens today in fund administration is happening kind of without any tooling. It's like, humans are taking like data out of this sheet and then like copying it over to this sheet. And then another human is coming in and like looking to see that work was done correctly. And then maybe a third human is like summing the columns of that sheet or something to see that the calculation makes sense. And that way of working does not make any sense. It sucks for the fund accountant. It sucks for the customer because like all the work's happening in a black box. They can't audit it. They can't see where the work is. And it's kind of crazy that we take it for granted that we can, order a pizza on DoorDash and, see exactly where that pizza is. Has it left the restaurant? Is it in transit? It's coming at 7:13 p.m. And then you have these really high value, complex relationships with your fund administrator. And the whole thing is like a black box. You're like, I have no idea what's happening. I have no idea where my data is. I have no idea where the work is. So to us, modern administration is about maintaining that and increasing even that investment in the service relationship, in the, sort of the notion of that relationship being about advice and consultation, but that it should be technology and software that's helping to do the work and so that the client can interact with that. Like it's, so many of our clients are so frustrated with the status quo because they don't have access to their data, basic stuff, like they only get access to their data in the form of a PDF that's sent to them or, so there's a lot of just principles of how technology systems work today that if applied appropriately to this problem set can really create a revolutionary experience for the customer in the same way that like we take it for granted now that we can just track the status of a FedEx shipment by putting a number into a webpage. And that's like way better for the customer than calling FedEx on the phone. So not every interaction should be via the phone, via human to human. And so we're trying to limit that set to what really makes sense and have technology do the heavy lifting on the rest.
Because it's so reliant on humans, I think there's been, at least in real estate, somewhat of a reluctance to move towards outsourcing. You made the comment earlier, nobody's going to allocate money with you because you have the best back office. But that's not to say having a great back office or back office support isn't important. How do you think about kind of this dynamic around, the industry shift towards outsourcing? And if you had a crystal ball that you could look into, where do you think we're going to be, 3-5 years from now on the outsourcing topic more broadly?
Well, it seems pretty clear to me that if you're in private equity or venture capital or real estate, you can just look to the world of hedge funds, and that is sort of the future, right? That asset class is much further ahead when it comes to these dynamics. And I think Bernie Madoff probably did more than anyone else to contribute to the rapid shift toward outsourcing fund administration. But I think what people realized, like today, if you're a hedge, we want to go out and start a hedge fund together, there's zero chance we're going to be successful at raising capital if our story is that we are going to self-administer that fund, right? Because the investors who are going to contribute money are going to be like, no way, I want to have an independent party looking at and taking care of the books. I want to have an independent party who's the custodian for that capital, because even if I trust that manager, you always have to be thinking about the Bernie Madoff scenario. And so it seems very clear to me that, probably 9.9 out of 10 hedge funds are third-party administered today. That will be the case in real estate. That will be the case in, other real asset categories, private equity, venture capital. Venture capital already is pretty, dominant on third-party outsourcing. Private equity is behind that, and real estate is very far behind that. And I think that the reasons for this are, one, LPs prefer it, right? So, and this just makes common sense. Like, I sleep better at night as an LP in the funds that I invest in if there's a third party that's preparing the books than if I'm relying solely on the GP to do that. Two, GPs actually prefer it, because most GPs, after they think about it for a while, are like, wait a minute, I'm not trying to build a really huge team of people that I want to manage, and I don't want to manage a super complex accounting operation. I just want to do my private equity style of investing, whatever that is, and create economic value for my stakeholders. So it's better for the GPs, it's better for the LPs, and you sort of have that dynamic, and then scaled providers can create a better experience than any one GP can. You get all those three things together. It seems very clear to me that the industry will be fully outsourced within probably the next decade. I think it'd be very hard to raise a real estate fund if you don't have your fund administrator picked out in advance.
Growing a fund admin business is, operationally intensive, right? It's very different. And, people are at the core of that. I mean, one of the things that I hear a lot about when I'm talking to our clients in the market is some of the struggles around attracting and retaining talent, especially talent that's specialized in fund accounting. How do you think about, how is Juniper Square positioned to both find and attract and then retain, the best people to be able to support our clients?
Yeah, it's definitely a huge issue. I mean, our fund administration business is growing at like 500% a year, and that's a lot of people that you have to hire to meet that kind of growth. And the reality is, this is, we have the same challenge in software engineering and other parts of our business. Although interestingly, with kind of the higher interest rate, higher layoff environment, the dynamic with software engineers has definitely changed relative to a few years ago. But in the world of fund accounting, there's some basic facts. And one of those is that there are not enough fund accountants in the world for the demand. There just aren't. And so you got to deal with that in one of two ways. One is you got to figure out how to make more fund accountants, right? So that's going direct to university hiring, and training people over time in the trade and the craft, and sort of developing them from within versus just going out and trying to find people who are already skilled up on the a job market. That's one thing. And then the second thing is you have to figure out how to make the worker much more productive, right? And this is where technology and tooling can come in. So if, a couple of years from now, as we think is reasonable, a fund accountant at Juniper Square can do 10 times as much work as a fund accountant at a kind of regular accountancy that's not a tech company, then we need 1/10 the number of accountants for the given, size of business that the peer set does. And so we've got kind of plans that are pushing on both of those vectors of, just how do we create more fund accountants in the world by going direct to university hiring. And that's not a small thing. These people want to be CPAs. They got to sort of train them up and have development programs and teach them how to work. And there's a lot to it. And then our technology roadmap of really transforming what it is to be a fund accountant and making them much more productive. And the union of both of those things is kind of I think the answer, at least that's what we think.
Final question on fund administration, but as you look back on the last few years since we've been in this space, what's been kind of your biggest learning or aha moment? What's been most surprising to you, either, positive or negative?
That's a great question. What has been most surprising to me? Well, I definitely have a lot of respect now for how hard it is to build a mission critical services business like fund administration. I have much more respect for that now than I did, say, 5 years ago. It's the type of business where getting it right, exactly right, really matters a lot. You're not saying to an investor like, here's approximately $1 million distribution, give or take 100K, like pennies and tenths of pennies and hundreds of pennies matter. And so, that kind of, just the volume flows, like we're at pretty significant scale. So any given month, there's tens of billions of dollars being raised via our subscriptions tools. There's tens of billions of dollars going out off the ledger into LP banking accounts. And so there is a mission criticality component to what we do where we have to have a very healthy respect for not breaking anything and not screwing anything up. And then there's a tension there between the desire to innovate and move quickly and sort of disrupt. And so I think probably the most surprising thing has just been how complicated these, services delivery businesses can be. And I think when we first were entering the fund administration business, I kind of remember sitting down with the executive who really built that business from the ground up for us on this napkin and sketching out for her. And I was like, okay, so fund administration is going to be our first business. And then there's 4 more right behind it. Like you'll work on those like a couple quarters from now once we get this one stood up. And, little did I know how naive that was.
So earlier on, you mentioned, this desire to digitize the relationship between the GP and the LP, the partnership, if you will, which would or could be in service of, making private markets more efficient. And you alluded to the kind of potential or future launch of a capital markets business. Let's talk a little bit more about, what is your vision there? What does capital markets at Juniper Square look like? Or what does it not look like? And then, how do you think about building a two-sided marketplace, which is, no small feat? And what do you need to do to be successful there?
Yeah, I mean, I think in terms of like, what does that look like or what's the end? Like, how would we know over the course of, say multiple decades of effort in this area if we were successful? And the way that I think about that is primarily about participation. So today, very few people can participate in the ownership of private equity directly. Like maybe you're a teacher and, your pension is provided by the, state in which you were a teacher, and that pension fund invests in private equity. And okay, so there's some degree of exposure there. But just in terms of everyday investors being able to invest in and hold private equity as they're able to invest in, stocks like Coca-Cola or Apple today is virtually non-existent. And so I take inspiration and look at like what happened with the NASDAQ exchange. So NASDAQ was launched in the early 1970s, and really was just like in the early days, a way of printing a stock price on a screen. It wasn't like a electronic trading and settlement system from day one. But it really has become that. And over that period of time, public stock ownership by U.S. households has gone from 15% to 60%, a fourfold increase in household participation and ownership of public stocks. And I think the same type of broadening of participation is very possible in private equity. And I think that'd be a really great thing for the world, because there's a tremendous amount of value that's created in real estate and venture capital and, buyout and growth private equity that, maybe very indirectly reaches that teacher via the pension fund's investment. But it'd be awesome if that teacher could invest and participate more directly. So our ultimate vision for the work we want to do in capital markets is driven by that goal. It is about broadening who can access and participate in owning and benefiting from these really productive, important corners of our financial ecosystem. And that takes the shape of doing a lot of work to remove cost from the system. So today, if every time you want to invest in a private equity fund, some lawyer that charges $1,000 an hour needs to review your subscription agreement, and it's never going to scale, right? You have to get the marginal cost of a trade down close to near zero, like it is in the world of public equities. And so that means things like automating subscriptions, automating redemptions, automating fund formation, automating the movement of money. And then it includes, what we're really interested in is how do you provide efficient, diversified exposure to the investor, to private equity. So, if you look at the rise of passive funds in the world of public equities, it's been tremendous, of going from, no dollars held in these ETFs and index funds to many, many trillions today. And it's a really great way, if you're not a stock picker, like I'm not a public stock picker, I'm in the Warren Buffett camp of just buy the S&P and hang on. There's no way to invest in private equity like that today, and no individual investor is going to be out trying to pick individual GPs. So we think there's a role that we can play in bridging that divide. And then the third big area is, one of the things that the public markets benefit from is having very deep and liquid markets for secondary trading. And so we take it for granted that you can buy that share of Apple today and then wake up tomorrow and change your mind and sell it, get your money back. And that's not how private equity works. Your money's locked up for 10 plus years. And to some degree, you have to respect the fact that a lot of the assets that private equity funds are investing in are themselves illiquid. So you can't just manufacture liquidity out of thin air. But we do think that this is where the industry is going, is toward offering more liquidity and the ability to remix the ownership without having to change the underlying composition of the assets. And we think there's a big role that we can play there over time, just given the point of aggregation and the scale that we've collected of private equity ownerships. Again, we've got 1 million positions where each one of those positions have an LP attached to them, a bank account attached to them, a subscriber profile attached to them. So we ought to be able to enable things like secondaries trading in a way that no one else can. And so that's really how we think about capital markets. It's about access ultimately. That's the ultimate yardstick that we're measuring ourselves against. And there's a bunch of different areas where we think we can innovate over time. And it's a big, this is not like we do this next quarter and we're done. This is a big sustained effort over a long period of time to have an impact.
I think it's super exciting, and obviously we're early on in the journey. I have experienced that myself, and I think the best is certainly yet to come. Changing gears a little bit, we're recording this in June of 2023. The macroeconomic environment is uncertain, to say the least. We just kind of nearly avoided catastrophic crisis of in the United States here with our debt ceiling. How do you see the world, the macroeconomic today, through the lens of a venture-backed technology company, through that kind of entrepreneurship perspective, what are you looking at? What are you feeling? Kind of what's impacting you and the business and the businesses that we support based on the macro environment?
So I think there's two ways to answer that question. One is just for like us as a venture-backed company. How do we think about the fundraising environment, going public, any of those types of topics? And then the other is we support many tens of thousands of private equity funds. So what are we seeing in terms of fund flows and new fund formation in private equity? And I can take both of those. So on the first one, we looked at this last spring, last April, not April of this year, but April of 2022, as really the market finally reacting and internalizing the Fed rate hike and the speed of that. And there's a giant correction in public equities generally, but it hit high growth tech stocks extremely hard. I mean, there were companies that were down 80, 90% plus that were great companies. And, really just coming off of the kind of crazy COVID, sort of Fed fueled bubble. And we looked at that and we're like, look, we need to make sure that we as a company take the opportunity now to raise all the money that we think we'll need ever to control our destiny, even if that means we got to raise it at lower prices than we would optimally like to. So we were really quick to take that medicine. We raised another $130 million last year just to say, you know what, who knows what the financial future holds, but we need to make sure that our company is capitalized for any one of those scenarios. And so that has sort of taken the pressure off of this idea that we need to be tracking where the public markets are in IPOs or where the late stage growth funding environment is, because we sort of taken ourselves off the table as being a seller into that market. And from everything I hear from peer CEOs and everyone else, it is still largely very, very closed in late stage growth fundings. You may hear about one every now and again, but by and large, that market is still very, very frozen. And so that's not great news if you're in a position of needing to raise money soon. And then more, stepping back more broadly, there's we look at the rate of new fund formation on Juniper Square. We look at the rate of digital subscriptions on Juniper Square. And I could tell you that the first half of this year is off to an extremely slow start. So like our count of digital subscriptions, originated by our GPs in the first half of this year is like half of what it was in the first half of last year. Our company has grown by 75% in that period of time. And this is not adjusting for that. So base of GPs who could be doing subscriptions is 75% greater this year than it was last year. And the count of subscriptions is down 50%. So we're just seeing this just like literally drop off in new fund formation, in LPs allocating. And the stories are different across asset classes, but across real estate, things like infrastructure, VC, PE, even private debt, and you can go look at PitchBook, Preqin, pick your third-party data source where this is publicly available. Our data matches the publicly available stuff. It's down 40, 50, 60% sometimes year over year. I think in real estate, Q1 was the slowest quarter in the last 5 years in terms of new fund formation. The only bright spot is secondaries funds. So, there's a little bit of a different story going on there, not surprisingly. But there's no question that there's a huge slowdown in private equity. And this is supported by all this anecdotal evidence that, we all have, but people are stretching their existing funds longer, waiting to raise, for another quarter, another 2 or 3 quarters or whatever the case may be. And to a certain extent, there's a need for asset value. There's still a big bid-ask spread in a lot of these markets. If you're a company like Juniper Square, why would you choose to raise capital now if you don't need to, unless you have the discipline like we did to say, well, let's take our lumps now. Who knows what the future holds? Could get worse. And so companies are sitting on the sidelines with their old valuation, which is, let's say 80% higher or 100% higher, who knows what, than the public market's equivalent. And that trade's not happening. We all are tracking the office market, right? Where just buildings are not trading, but everybody knows, and the handful of trades that you do see are happening at like 60% discounts to the last marked price. But the reality is there's no transactions happening. And so the sort of the market is seized up. And so it's until those bid-ask spreads narrow, until we start to see more transaction volume, we're not going to see the fund flows into these asset classes because everybody's sort of waiting. All the LPs are waiting for that vintage where it's like, yeah, great. Now is clearly the time to invest in office, right? Like you want to invest in office post-correction, not pre-correction.
One of the things leading up to, the latest inflection point where the markets, went south was, the venture markets really valued growth. And, my understanding is that as a result of the degradation of the macro environment, the venture markets are really valuing efficiency. Talk a little bit about kind of what that shift between growth and efficiency means at Juniper Square, but more broadly, I mean, it impacts everybody who has venture capital in the startup ecosystem, all of our peers and, all the technology and services companies out there.
Yeah. Well, I think that, there was certainly, I'm trying to separate the craziness of the COVID era from the like general properties of the 15-year boom, like the, zero interest or close to zero interest boom over the last, a period since the global financial crisis. And I think that for a long time, there was so much trust in the investing universe that as long as businesses had a certain shape and a set of characteristics, like most of their revenue was recurring, the gross margin was high, it was a tech company, that those companies could just burn whatever it took to grow quickly, because like at any point in the future that they wanted to, they would just like flip this bit and all of a sudden they would become these cash flow machines. And that was a very, very deeply held belief, and it enabled everyone to kind of adopt the shorthand of valuing all these businesses as a multiple of revenue instead of, the actual economic theory would suggest, which is like a multiple of the free cash flow that they generate. And that was something that was like a 15-year thing that happened. That wasn't just a COVID era thing. And I think what's changed is everyone has realized that, wow, if you're in a 5% risk-free rate environment, having cash really matters. Like having that cash today really matters. Like your business being profitable today, not 5 years from now, really matters. And all of a sudden, the ability to, take $1 and convert that to free cash flow today is worth so much more to an investor than your idea for disruption 10 years down the road, And that has been a huge sea change. It happened very, very quickly. It was a 15-year period of something, and all of a sudden, within like 6 or 8 months, everyone has completely changed their tune. But if you're a late-stage investor and you look at the public markets and you're like, wow, here's a company that's trading at 5 times next month GAAP revenue, right? Or maybe 6 times is where the median tech company is trading right now. And then you look at some private markets company that did their last round at 100x, ARR, however that company defined ARR, but probably not GAAP revenue. Like there's literally a mile of difference between those two valuations, and that's why the market is really stuck. And so I think the companies that what we've tried to do, we took our medicine here. We restructured the company. We were relatively quick to do it last year to say, okay, we've got to get the cost profile of the business onto a sustainable path, given this new set of facts of the world that like we're operating in a 5% rate environment, not a 0% rate environment. And then, we don't try to predict the future. I don't know when new fund formation will return to, or if it'll ever return to like, Q4 21, Q1 22 levels in private equity. But we just assume that the current depressed rate is the status quo for the future, and then we need to be able to operate through that. And we need to be profitable through that. And so that's how we've approached it. And I think the well-run businesses are approaching it the same way. And then I think there are some entrepreneurs out there that are just honestly rolling the dice on time, that like something's going to change a quarter from now, 2 quarters from now, the market's going to come back. and that 100x ARR round that they did is not going to seem so crazy. And I'm all in on that trade with those entrepreneurs. I hope that they're right, but it's hard to run a business that way.
So as we begin to conclude here, I want to focus the last few minutes on kind of what you see going forward. We talked a little bit about the origin story of Juniper Square, the development of our software and administration business, and emergent capital markets initiatives. Today there's a lot of talk around the power of technology with LLMs, large language models, and the GPTs coming out. What do you think is kind of the next wave of kind of technological disruption or technological evolution over the next 3 to 5 years?
I mean, I think it'd be pretty hard to say anything other than generative AI and these large language models that ChatGPT has popularized. It really, it affects different types of businesses differently. Like a lot of the demos that people see are of like, hey, I want to generate some code to build a website, completely clean environment, just like build me a web page, put a button here, put a picture there. And, generative AI is like really good at those types of scenarios. And in our type of case, we have both like a really large existing code base that has a lot of context in it that engineers have to know how to fit like their new features into and make sense of. And these large language models are less good at that. And then the other thing is these large language models are really good at being approximately right. Like they if you're an expert in a field and you spend any time with them, you realize, okay, they're really good at like that surface level, asking ChatGPT questions at the surface level will give you these very compelling answers, like at the level that a journalist might write an article on a topic. But if you're an expert in a topic, you realize actually they're factually incorrect. They're all over the place. They can't make the right inferences. And in our type of technology problem, getting the numbers exactly right, matters a tremendous amount. And so I think on average, some of these tools might be less impactful for our type of business than they are for other types of businesses, but we're taking it super seriously. And a lot of it is too, just taking the tool sets that are obvious and get developed elsewhere and incorporating them into our business to make our customer support people more productive, to make our salespeople more productive. These are the basic building blocks that every business owner, even private equity, real estate, investment firm business owners need to be doing. Doesn't mean you have to like have your own engineering team generating these language models, but you need to be able to incorporate them and change your business to adapt to these technology disruptions. Because this really is a platform shift in the same way that like mobile, or I think it will become to be seen, a platform shift in the same way that mobile was a platform shift or web initially was a platform shift, which means that businesses need to figure out how to retool around it versus just think of it as like an add-on to the business. And then there are areas within our role of, we have many millions of documents collected on our system. We have an extremely extensive record of private equity ownership across many decades of history, oftentimes. And so we do think and we're experimenting with roles that these new technologies can play in creating new products for our customers, new ways for them to interpret, their own investment performance, their own data, new ways to draw conclusions, new way to get insight out of data that might be locked up in documents, let's say. So I think there's going to be whole new products that get created that are really interesting. So that's the one where I think I'm very interested in it. And as a company, we're taking it very seriously.
So final question, building a startup is hard. Building a startup over the last, decade, or especially the last few years, is arguably even harder. Yet, every day you wake up, you're leading the business, we're marching forward and we're doing so at a very rapid clip. What are you most excited about, or what keeps you kind of motivated to, get up every day and continue to build for our customers and for the industry?
Well, we've sort of started out with this vision that is the same vision that we have today, which is really ultimately about, broadening access to private equity ownership. And that's, for me personally, a very inspiring vision for our employees. It's an inspiring vision. I think many of our customers are excited by that vision. And as long as every day you wake up and you feel like, even on the hard days, you're just inching, it can be inches, it might be centimeters some days, sometimes it's leaps and bounds, but you're making progress toward that vision becoming a reality. That's a very inspiring, there's a lot of reward that comes from that, even on hard days. And it's been crazy to navigate through, all of us, having to go through COVID, and then, the macro environment shifting so rapidly. And there's been so much to navigate through. And, but that, just trying to stay true to, are we making progress incrementally toward the vision, is kind of like the unifying force. And that's what keeps us going every day. And that's what will keep us going, hopefully 10 years from now. And, it will take that long to have the kind of impact we want to have.
Awesome. Well, Alex, I really appreciate you joining me today and sharing your insights. It's always great to hear you describe your personal journey and the journey of Juniper Square. And I remain as excited today as I did on the day I joined the company many years ago. So thanks again.
All right. Thanks for having me, Brandon.